Hello dear students, this is Professor Aagam Dalal. On behalf of Judicial classes, I welcome you all. Today we are going to quickly discuss statutory updates and judicial pronouncements that are issued by ICAI for November 2024 attempt of CA Final. So this video is for those students who are going to appear CA Final exam in this November 2024, not for any other student. The first doubt which many students have asked me already, which I have clarified to the various platforms, but over here still once again I am going to clarify. The budget which just came on 23rd July, it is not applicable for November 2024 examination. That is applicable from May 25 and onwards. So first of all, for you there is no huge amendments. For you, capital gain will be calculated as it is. Tax rates are as it is. 115 BAC, old tax rates are only applicable, which you have studied by that 3 lakh rupees of slab. Today we are going to discuss those statutory updates, that is the notifications, circulars or some kind of extensions that has been issued by CBDT up to 30th April 2024. Majority of them were already discussed in the class, but still, just because ICAI has given it as a separate PDF, we will be discussing it very quickly. What I have done is, ICAI ka PDF I have converted into the short summary format. It is reproduced over here so that in a very quick time you can refer the entire statutory updates and judicial pronouncement that are issued by ICAI. First we are going towards statutory updates. The very first chapter, capital gain, in which statutory update is there. Section 47 clause 7AB. Now first of all, we know that if a non-resident transfers some of the asset, specified asset in IFSC ka recognized stock exchange and the transaction is done in foreign currency, then that particular capital gain is exempted. So a non-resident transfer is done in IFSC ka recognized stock exchange in foreign currency, specified asset, capital gain will be exempted. Now what are those assets which needs to be transferred? Bond, global depository receipt referred in section 115 AC subsection 1, rupee denominated bond of Indian company or any derivative or any other security as may be notified by central government. Now there are many securities which are already notified by central government prior also, which we have studied in the class. Few more securities which are notified for this clause. So what are those few more securities? Units of investment fund being REIT or InvITs, that is investment fund. Units of a scheme under IFSC authority which is registered, or units of exchange traded fund which we call it ETF. If these are the asset which you are selling it or transferring into IFSC ka stock exchange and the transaction is in foreign currency and you are a non-resident, that particular capital gain will be exempted. It won't be treated as a transfer. It won't be treated as a transfer. You don't need to calculate capital gain also. So these are the securities which are added in this list. Assessment of trust and institutions. In that there are 3 statutory updates which you need to take care. We know that any trust is required to invest 2 things. First, corpus fund. Second, amount which is set apart. These 2 things they have to invest under the modes prescribed under 11 subsection 5. Now, in that list of the modes which are prescribed under 11 subsection 5, one more investment is added, and that is investment by way of acquiring units of Power Grid Infrastructure Investment Trust. So that is a particular entity, Power Grid Infrastructure Investment Trust. If you invest in the units of that trust, that is also allowed. So a trust who needs to invest 2 things, I repeat, corpus fund and the amount which is set apart. They need to invest into 11 subsection 5 and one more investment is prescribed now under this list. Second point which is very important for the exam also, you need to take care of this very carefully. Whenever a trust which is registered under section 12AB or as the case may be 1023C can donate 2 things. First, it can donate to some other trust registered under 12AB or 1023C, either of them. So here both 12AB is also covered, here also 1023C. So you are donating first of all to that particular trust which is also registered. Now that donation can be corpus donation for that other trust. It can be non-corpus donation for that other trust. Now if it is a corpus donation for that other trust, then it won't be treated as an application for the donor trust, because for the recipient also it is not taxable. However, if you donate to non-corpus fund of some other trust, then to that trust 15% exemption will be available. So to that trust only 85% income will be taxable, and hence for the donor trust also application will be allowed up to 85% of such donation. So let's say there is a trust A which is donating to trust B. The donation is non-corpus in the nature. The donation is of rupees 1 lakh. How much is application of the fund for trust A? It will be 85,000 after deducting 15% ka exemption. So that has been already taught in the class. Now what is the clarification that is issued by ICAI? See, you have donated rupees 1 lakh na? Means from the trust total 1 lakh rupees has gone out of the fund. However, how much is allowed as an application? 85,000. Now what if the trust is having a surplus including that 15,000 which is not allowed as a deduction? Trust has that surplus and trust wants to set apart the money by form 10. Then it has to be invested in 11 subsection 5. However, up to this 15,000, though it is allowed as a set apart, but for that 11 subsection 5 ka investment is not necessary. Why? Because the trust is not having that money into the hand, it is already donated to other. The only problem is just because it is donated to other trust, we are claiming deduction up to 85%. We are not claiming deduction of balance 15%. That doesn't mean that 15% should be invested in 11 subsection 5. From where I get the money of that? It is already donated to other. And that's why, though that particular amount is set apart, which will be used in future to save the tax, but that is not required to be invested in 11 subsection 5. That has been clarified by CBDT. When a trust donates to non-corpus of other trust, it will be treated as an application only up to 85%. Balance 15% is not treated as an application, this we all know. However, this 15% is also not required to be invested in 11 subsection 5 because that fund is donated to other, though it is not treated as an application. We don't have that fund into our hand, and that's why we can't donate to other. We can't invest into 11 subsection 5. Now, there are two kind of registration which a trust needs to take. First of all, there are many registration which a trust needs to take. Earlier, the trust which were registered under section 12AA, now it has to get transitionally registered under 12AB. They have to file form number 10A, wherein they will be given new 12AB ka certificate. And that due date is already over. That due date was already over. The transitional period was done. Now those who forgot to do transitional registration cannot do that transitional registration. They have to take a new registration of 12AB. So many trusts argued that we were under ignorance, we forgot to do transitional registration. Though CBDT has given huge deadlines earlier, huge extensions earlier, still many trusts have requested one more extension please, and CBDT has also allowed that. The extension was up to 30th June 2024. So CBDT issued a circular that those who forgot to file transitional registration ka form number 10A can still apply for transitional registration up to 30th June 2024. So for transitional approval, extended till 30th June 2024. One more thing, whenever you are provisionally registered and now you start your activity, within 6 months of starting of the activity, you have to apply for final registration. If you forgot to apply within 6 months, then after 6 months you can never apply for final registration. It was a dead end. So many trusts forgot to register under final registration even though activity started. Within 6 months they forgot to do final registration. That means that trust can never be registered under final now. So those trusts also requested CBDT that we were not sure about whether we are registered, we are supposed to register now or it will be allowed later. So we have not registered ourselves into final registration. And so CBDT has again extended that deadline also up to 30th June 2024, that those who forgot to do final registration, even though activity started, even though 6 months have lapsed, they all are eligible to do final ka registration. They can do application for final registration up to 30th June 2024. So where final registration is to be obtained within 6 months from the date of commencement of activities. If any trust has missed that timeline, then it can apply for final till 30th June 2024 under form number 10AB. So for transitional registration and for final registration, Those who forgot to do it earlier, the due date was extended till 30th June 2024. That was the third circular over here. Now, so far as the very important statutory updates are concerned, TDS chapter, it is the highest statutory updates. The very first is regarding section 194A. What is section 194A? TDS on interest other than interest on securities payable to any resident at the rate of 10% TDS will be deducted. However, one budget back, which is applicable for your budget, our Finance Minister Nirmala Sitharaman has issued one certificate for women in post office, that is Mahila Samman Saving Certificate 2023, having 2 years of investment with a great interest rate of around 7.25% payable quarterly. The circular says that no TDS will be deducted on the interest paid under such certificate. So whatever interest is being paid by post office under this particular certificate, it won't deduct any kind of TDS. Then section 194, that is about TDS on dividend payable to a resident company by a domestic company more than 5,000, 10% TDS will be deducted. However, there is one section 10 clause 34B. Now what that 10 clause 34B says that if you are a unit of IFSC engaged into the business of leasing an aircraft, and if you give dividend to any other unit of IFSC, because it is the shareholder in your company and you are giving dividend to that unit which is also into IFSC, which is also engaged into leasing of aircraft, that dividend income will be completely exempt. That is said by 10 clause 34B. Now if that dividend is completely exempt, what is the need of deducting TDS also? And that's why CBDT has given a relaxation with effect from 1st September 2023. No TDS under 194 will be deducted from a dividend which is paid by unit of IFSC engaged in the business of leasing of aircraft to a company which is a unit of IFSC engaged in the business of leasing of aircraft. For both, the business should be leasing of aircraft. The payer company and the recipient company both should be under IFSC. Then this dividend will not be taxable, subject to a declaration. That is okay. Then section 194I, rent. Now understand, if you are a company or you are a person which is engaged into leasing of aircraft into IFSC, whatever is your income, you will get 80 LA ka deduction, because that leasing of aircraft business is eligible for deduction under 80 LA. If you are engaged into IFSC center, that is International Financial Service Center, Gift City. Now in that case, if you receive any kind of dividend, any kind of rental income, any kind of interest income, all you will get is 80 LA ka deduction. Now if you are going to get 80 LA ka deduction, if you are getting any rental income, then why TDS under 194I should be deducted? For even that also, there is one relaxation given from 1st September 2023. No TDS under 194I on the lease rent paid by lessee to lessor engaged in the leasing of aircraft in IFSC. Up to the period, lessor is covered under 80 LA. So if I am a lessor, I am under IFSC, leasing of aircraft is my business. For the rental income, I will get 80 LA ka deduction, means nothing will be taxable for that rental income. Then those who is paying me rent will not deduct my 194I ka TDS. That is applicable from 1st September 2023. Very important is 194O. TDS by e-commerce operator of e-commerce participant. Now if you are an e-commerce operator and a e-commerce participant has supplied the goods or services from your platform and receiving the consideration either by e-commerce operator or from the customer directly, on that gross consideration, e-commerce operator is supposed to deduct TDS at 1% under section 194O. This section overrides every other section except 194S. It overrides every other section. Now there were some clarification required because there are many complex transactions that can take place over here. The very first transaction, wherein two e-commerce operators are engaged into one particular transaction. Now what is happening over here? Let's say there is a buyer. Buyer is purchasing some goods from platform number 1. So platform number 1, that means what? There is some website over here which we call it e-commerce operator. This is eco number 1. which is providing buyer interface. Now it has booked the order. Now this eco will pass on the order to some another eco, which is handling seller viewpoint, which is handling all the sellers. So seller will supply the goods to this eco number 2. That eco number 2 will supply the goods to eco number 1, and eco number 1 will supply finally the goods to buyer. So similarly, buyer will pay to eco 1, eco 1 will pay that to eco 2, and e-commerce operator 2 will finally pay it to the actual seller. The question arises, who is supposed to deduct TDS over here? So TDS is to be deducted by second e-commerce operator, which is finally making payment to that seller. So that has been clarified over here. If there are two e-commerce operator engaged in the transaction, like one from buyer side, one from seller side, wherein buyer makes the payment to buyer side eco, that eco makes the payment to seller side eco, and that finally makes the payment to actual seller, here TDS will be deducted by seller side eco of the seller. So here this particular eco will deduct TDS of this seller. Now what if here there is no actual seller, that seller is also third e-commerce operator. Now many e-commerce operator can be like that nature, which don't pass on the order. They actually purchase goods and services from the ultimate seller, and they themselves as the e-commerce operator provides that goods and services to others. So let's say there is a transaction wherein buyer books an order through one e-commerce operator. Now that e-commerce operator is just a buyer interface. It is transferring the order to seller interface, that is seller side e-commerce operator. Now who is the actual seller? That is also e-commerce operator. Now there is no further actual seller. There is a dead end over here. The goods and service will be supplied by this actual seller e-commerce operator. Now here who will deduct TDS? Because all are e-commerce operator. So what CBDT says that the last e-commerce operator is actually not behaving like e-commerce operator. It is actually behaving like e-commerce participant. We will consider it same like a e-commerce participant. So here also this seller side e-commerce operator will deduct TDS of this actual seller e-commerce operator, which is actually e-commerce participant. So if there are three e-commerce operator engaged in this transaction where eco itself is a seller of goods and service, there is no other seller, here TDS will be deducted by seller side eco of seller eco. In all these above two cases, on what amount TDS will be deducted will be the gross amount of goods and services. So now the question arises, what is the meaning of that gross amount of goods and services? Now there are so many elements that are involved when the transaction is done through e-commerce. So let's take one example and understand this in a better manner. I have written one example very similar to ICI example only. I have not created on my own. I have just redrafted ICI ka example over here. There is a person, let's say Mr. Aagam, who is a buyer. I ordered the goods worth rupees 80,000 from buynow.com, which is a buyer side eco. Now buynow.com has passed the order to amazon.com, seller side eco. Amazon.com passed the order to JK Limited, let's say, who is the actual seller, that is e-commerce participant. How much worth of goods is purchased? 80,000. Now seller is ready to sell the goods of 80,000 plus packaging charges, shipping charges, convenience charges of 10,000 is also added. So how much seller will charge total invoice value? 90,000. Seller will raise the invoice of 90,000. Buyer paid 90,000 to buynow.com, because buyer don't know Amazon, buyer don't know JK Limited, buyer know only buynow.com. So buyer paid 90,000 to buynow.com. Now that particular eco will take its platform fee. It retained 2,000 and balance 88,000 transferred to amazon.com. Amazon.com will also retain its platform fee. So it retained 1,000 platform fee and paid balance 87,000 to JK Limited. How much of invoice JK Limited raised? 90,000. How much actually it got? 87,000. Where that balance 3,000 rupees went? It went with e-commerce operator as their platform fee. That is one kind of commission that they have taken. However, here law says, though it is a commission retained by e-commerce operator, 194H will not come into the picture because this is a transaction through e-commerce. So that's why which section will override 194O, and entire TDS will be deducted under section 194O. Here seller is not supposed to deduct TDS of that commission under 194H of e-commerce operator. Here e-commerce operator, that is Amazon.com, will deduct TDS of seller, that is JK Limited, on entire 90,000, the gross invoice value. Here Amazon.com will deduct TDS of JK Limited for 90,000 gross amount of fees, which include the charges also. Generally, the money retained by respected ecos are subject to 194H. However, 194O deducted on gross value, which include that commission amount also, and hence again 194H cannot be deducted. So here I have given one definition. Gross value will be sale value plus other charges added by seller. Platform fee deducted by ecos are not to be reduced. On that also TDS will be deducted. Example number 2. Now here that can be a different thing, that let's say seller wants to charge. See what happened in example number 1. In example number 1, seller wanted to charge 90,000, but ultimately he got 87,000. So that 3,000 rupees of platform fee is ultimately, can I say, borne by seller. Now that can be the case where seller is saying that I will charge my full rupees plus I will add whatever platform fee you are supposed to charge as e-commerce operator, and that also I will charge from the buyer. So let's say Mr. Aagam buys the order from buynow.com of rupees 85. Buynow.com charged rupees 10 as platform fee and Amazon.com charged rupees 5 as platform fee. So how much will be the total amount payable to seller plus Amazon.com plus buynow.com? Total it will be 100. So what seller is doing? Seller is raising the invoice of 100 rupees only. From that what it will do? Buyer will pay 10 rupees to buynow.com, 5 rupees retained by Amazon.com. Ultimately 85 rupees will go to the seller. So seller will get 100% value which it was supposed to charge. And this platform fee is indirectly charged from buyer. This is the second example, the most common example, wherein always the fees are taken from buyer. Now here the question arises, on what value TDS will be deducted? So the CBDT circular is very clear. We will deduct TDS on gross value, that is 100 rupees. Though 10 rupee belong to buynow.com, 5 rupee belong to Amazon.com, but TDS under 194O will be deducted of the seller on 100 rupees. So whether now seller is required to deduct TDS under 194H for the commission taken by this e-commerce operators? No, because the entire TDS is deducted of seller over here. So 194H will not come into the picture again. The next question over here is, what will be the impact of GST, VAT, sales tax, etc. See, it is always over and above invoice value. So let's say taxable value is there plus GST, total will become invoice value. Question arises, 194O ka TDS to be deducted on taxable value or invoice value? See what CBDT says that 194Q and 194O are very similar to each other. In a way, they both are talking about goods mainly. 194Q is offline transactions, 194O on e-commerce platform transaction. So let's keep the rules same for both of them. So same circular which was issued for 194Q, similar circulars are issued for 194O also. Now what they says? Here in 194O, when TDS is supposed to be deducted? At the time of payment or credit in books of account, whichever is earlier, that is payment or accrual, whichever is earlier. Now let's say in this, payment is coming earlier. If payment is coming earlier, TDS is to be deducted at the time of payment. There we don't have the breakups of taxable value, GST, etc. So e-commerce operator will deduct TDS on the entire value which is being paid, including GST. But what if credit in the books of accounts comes first? The invoice comes first. In that too you have a clear bifurcation. Now what is taxable value, what is GST, what is other taxes, what is invoice value? On what amount you will deduct TDS? Invoice value or taxable value? Taxable value, that is before taxes. If TDS deducted at the time of credit in the books, taxes are shown separately. TDS to be deducted on the amount excluding taxes. However, if TDS deducted at the time of payment, because that was earlier, TDS will be deducted on the entire amount including GST. Now again one more question arises over here, that what if from e-commerce participant goods went to the buyer and the transaction is done, TDS also deducted by e-commerce operator. But what if that goods are defective or that goods were not up to the marks? It was returned by the buyer, purchase return. Now there is a purchase return. Then in that case, there can be two kind of things that can happen. And this is also same like 194Q. Either the seller can refund the money to the buyer through e-commerce operator, or seller can replace the goods and can finally close that transaction. Now let's say first transaction happened. Buyer, eco, seller. Here buyer paid rupees 1 lakh, seller transferred the goods, but now these goods are particularly not up to the marks, so purchase return took place. Now what seller did? It replaced the goods and it passed on some another good amount of good quality wala goods to the buyer. So what CBDT needs to say? In the first transaction itself, eco has deducted TDS of the seller. Now here, because of purchase return, just the goods are being replaced, nothing to be done in addition. TDS was deducted earlier, things are done, matter closed. So if you see over here, if in case of purchase return, if the goods are replaced, no further adjustment of TDS required. However, let's say here goods are not replaced. Buyer says that I don't want another goods, please give back my money. Seller is giving 1 lakh rupees back to the buyer. But now what will happen? Seller has earned nothing, but still eco has deducted TDS under 194O of the seller of rupees 1 lakh. So now what they can do is, whenever through this eco, seller will sell some further goods to some another buyers. Up to rupees 1 lakh, eco will not deduct TDS again because it was deducted in advance in that earlier transaction. So it will be adjusted towards the subsequent transaction. So let's say in the same financial year, seller has sold the goods worth rupees 3 lakh to some another buyer. So what that e-commerce operator will do? It will deduct TDS only of rupees 2 lakh. Because of that rupees 1 lakh, TDS was already deducted, which is still there. Because the transaction was not done, it was returned back, but TDS was deducted. So on that again TDS will not be deducted. On only balance 2 lakh rupees, eco will deduct TDS of the seller. So now one more question will arise. What if there is no other transaction in the financial year? This was the only transaction, which is purchase return. So in this case also there is no adjustment required further. Though TDS is deducted, the seller can claim the credit of that TDS. It will not show anything into the sales, or it will show something into the sales. Against that there will be purchase return. It has a valid clarification. TDS credit will be available anyway. So if the money is refunded, TDS deducted will be adjusted against the next transaction by deductor from the same deductee in same financial year. And if there is no further transaction, that is okay. No adjustment is also required. That TDS will be allowed as a credit further. The last clarification that CBDT has given over here. What about the discount which is offered? So let's say ki, for example, here Mr. Aagam is there. Here Swiggy is there, e-commerce operator. And here let's say there is a restaurant, for example JK Hotels. Now JK Hotels supplied one kind of goods, that is one kind of dish to Mr. Aagam, who bought it from Swiggy. That catalog price in the menu was 150, but if somebody orders through Swiggy, then this hotel is giving a discount of 20 rupees. So basically what invoice they will raise? 130. What amount Aagam will pay to this e-commerce participant? 130. What was the invoice value? 130 after deducting the discount. On what amount TDS will be deducted? 130, because that is only the invoice value. Now let's say here Mr. Aagam is there. Here Swiggy is there. Here JK restaurant is there. JK restaurant has a dish which contains the price of 150. It has said to Swiggy, I will take 150. Swiggy wanted to expand the business and to attract the buyer. Swiggy itself is giving a discount to the buyer. It said to the buyer that the dish is only of 130. So buyer paid 130 to Swiggy. Swiggy paid 150 to the hotels. 20 rupees is borne by e-commerce operator to expand its business. Discount is given by e-commerce operator. Now here, on what amount TDS will be deducted? So think now, what money went to the seller? 150. So on what amount TDS will be deducted? 150. So see, if discount is offered by seller itself, it will be deducted from invoice itself, TDS to be deducted on the value after deducting discount. If TDS is offered by e-commerce operator, then in that case TDS to be deducted on gross amount and not after discount, because that e-commerce participant is getting full amount. So again, that is clarified by CBDT. The next chapter which has statutory update is assessment procedure. Assessment procedure. The first update is under section 139A, quoting permanent account number. Now you know that CBDT has given a circular wherein there are so many cases wherein as a KYC permanent account number is required. For example, if you open a current account or cash credit account, permanent account number will be asked. For applying debit card, credit card, permanent account number will be asked. If you purchase any vehicle other than two-wheelers, your PAN will be asked for. If you deposit more than 50,000 cash in a bank, your PAN will be asked for. There are so many this kind of transactions. However, what if a person is not having permanent account number and he is not supposed to take it also because he is not covered under the criteria of 139A? So that person has not obtained permanent account number. That person has no permanent account number. That person is entering into such transactions. Then what is to be furnished? One option is the person can furnish Aadhaar number in lieu of PAN. The second option is that person can furnish form number 60, a declaration that I am entering into this transaction. I am supposed to give permanent account number, but as per 139A, it is not mandatory for me to obtain permanent account number. So I am furnishing a declaration form number 60. But CBDT has now closed this option of form number 60 for company and firm. So if a company and firm entering into such transaction is not having permanent account number, still they can't have form number 60. Indirectly for them PAN is required because they don't have Aadhaar also, na? So indirectly for them now compulsory PAN will be required because they can't furnish form number 60. So see, first of all, there is a list of transaction wherein PAN quoting is compulsory. If a person entering into such transaction not having PAN, then declaration in form number 60 is to be furnished. However, CBDT has taken back this relaxation of form number 60 from company or firm. From 10th October 2023, the lining goes like, form 60 can be furnished by any person not being company or a firm. They indirectly what it means to say, they compulsory needs to take permanent account number before entering these transactions. So now there was one more doubt which arose, that company or firm can't have form number 60. For them PAN will be compulsory if they enter into such transaction. But let's say I am a foreign company. I am dealing into IFSC ka bank, opening some accounts in that IFSC, current account. Or I am doing fixed deposit of more than 5 lakh rupees in a financial year. That are the transaction covered by CBDT circular for quoting permanent account number. I am a foreign company into IFSC doing such transaction. I don't have any other income taxable in India. Why should I take permanent account number? Up to now for me form number 60 was required, that I will give a declaration that I am into IFSC, opening current account in IFSC, foreign company, I am not having any kind of income taxable in India, and that's why I will not take permanent account number also, I will furnish form number 60. But that benefit is taken back by CBDT from firm and company, not from foreign company. So exception created. Company and firm can't have form number 60. Of that further exception created, some companies can furnish form 60. Now what exception ka exception says that a foreign company who does not have any income chargeable to tax in India and does not have a permanent account number entering into below mentioned transaction in IFSC banking unit can furnish declaration of form number 60, for which transaction form 60 is allowed for a foreign company. For opening account other than term deposit or saving account, like for current account or cash credit account, they can furnish form number 60. या तो for investment of term deposit in a bank, post office, nidhi company, NBFC more than 50,000 in single transaction or more than rupees 5 lakh in a financial year, even they can also now furnish form number 60. So remember first thing, form number 60 cannot be used by firm and company. However, if you are a foreign company not having taxable income in India, entering into transaction into IFSC banking unit, then for you form number 60 ka option is still available. Two more things now. There are certain transactions, if you enters into those transactions, you have to compulsory take permanent account number. You have to compulsory obtain permanent account number if you don't have up to now. First transaction in that list is if you deposit more than or equal to 20 lakh rupees cash in a bank or post office, PAN is to be applied. If you withdraw more than or equal to 20 lakh from bank or post office, PAN is to be applied. And if you open current account or cash credit account, then also PAN is to be applied. However, from 10th October 23, for above 3 transaction, PAN not to be applied if you are a foreign company or a non-resident entering into IFSC banking unit and not having income chargeable to tax in India. So, because see, they don't have taxable income in India, even though they do this above 3 transaction, why should they take permanent account number? What they will do of that permanent account number? So for them, permanent account number requirement has been removed. This can be asked in small questions, so just remember that. So there are two kind of circular which is issued. One was regard to form number 60. For foreign company in IFSC it is allowed. Second was for requirement to obtain permanent account number. But if you enter these 3 transactions, then still for a foreign company or non-resident, PAN is not compulsory if they don't have taxable income in India. Then you all know that section 142 subsection 2A. Now what is 142 subsection 2A? Valuation of inventory and doing special audit. So if there is a scrutiny going on, notice was issued under section 143 subsection 2. AO is checking the transactions, or there is a case reopening under section 148 and AO is checking your transactions and books of accounts are complex, method of accounting is not done properly. So basically they can order special audit wherein a CA will come and he will check your accounts, furnish a report to AO. Now similarly one more things are added. Now for inventory valuation they can appoint a valuer also who will value the inventory specifically and furnish the report to AO. So 142 subsection 2A discuss about special audit and inventory valuation. For that it is now clarified that every Chief Commissioner of Income Tax will maintain a panel of accountants, that is CA, and cost accountants. So CA will be helpful for special audit, cost accountant will be helpful for inventory valuation. Whatever is the expense including the remuneration will be not less than 3750 per hour, but not more than 7500 per hour. So it is not less than 3750, not more than 7500 per hour. And how much hours they will work, it will be clarified by AO under the order itself. See, it is not like an auditor says that I have to work for 2000 hours, pay me like that. No. AO will clarify in the order itself that this much hours will be required to complete your report. And accordingly, up to that much hours only payment will be done. How much payment will be done by income tax department to their auditor or cost accountant? Not less than 3750, not more than 7500 per hour. That has been clarified. Okay, point number 3 important. There is a section 206 AA. If you don't have a permanent account number, your TDS will be deducted at applicable rate or 20%, whichever is higher. Now there is one more section 139 AA quoting Aadhaar number, which says that every permanent account number has to be linked with Aadhaar number. If you fail to link, then after 1st July 2023, that was the cutoff date. After this, still if you have not linked your PAN with Aadhaar, your PAN will become inoperative. And if that PAN became inoperative, then as per section 206 AA, higher TDS is to be deducted. Similarly, as per section 206 CC, higher TCS is to be collected if your PAN and Aadhaar is not linked with each other because it became inoperative. So from 1st July 23, higher TDS, higher TCS ka provision is applicable. Now what happened is, let's say there is a month of August 2023, November 2023, January 2024. I deducted TDS at a normal rate of any person as per the section. I didn't know that he has not, he has not linked his PAN with Aadhaar and his PAN has become inoperative. I have deducted TDS at a normal rate. But Traces knows that that person has not linked Aadhaar with PAN. So basically Traces has made that PAN inoperative. and it issued a notice to the deductor that you have deducted lower TDS. You are supposed to deduct higher TDS as per 206 AA. You have not deducted that higher TDS. We will demand that from you along with interest. So notice of short deduction of TDS came to the deductor, to the collectors. Deductor collector went to CBDT that please allow us the relaxation, will take care from next financial year. We didn't know this happened all of sudden. We will take care from next financial year. Please give us some relaxation in this financial year. CBDT gave the relaxation that if the TDS is deducted up to 31st March 2024, but that particular deductee has not linked PAN with Aadhaar, and that's why his PAN was becoming inoperative. It's okay if you deduct normal TDS, provided that deductee has to make that PAN operative up to 31st May 24. Now what if I have deducted normal TDS up to 31st March 24 in ignorance of inoperative PAN? That deductee is making that PAN operative till 31st May 24 by linking PAN and Aadhaar. I will get no notice of short deduction. It is totally okay. Example 2. I have deducted normal TDS up to 31st March 2024, but that deductee has not made his permanent account number operative till 31st May 24. It is still inoperative. My short deduction notice is valid. I have to pay the balance TDS from my pocket as a deductor. I am under default, deemed assessee in default. See, if PAN Aadhaar not linked, then TDS is to be deducted at a higher rate of 20%. CBDT has given a relaxation that if transaction is entered up to 31st March 24 with such person whose PAN has become inoperative and such PAN is made operative till 31st May 24, then such higher deduction is not required. So indirectly they mean to say, if such person has not made it operative till 31st May 24, then still that higher deduction was required and notice will come to you. Fine. The very next chapter in which the changes are there, tax audit and ethical compliances. We have seen the entire tax audit reports, form number 3C, A, 3CD, 3CB, 3CD. Specifically, there are some changes in form number 3CD. There are some additions which are made. Now, what are the additions which are made in form number 3CD for the financial year 23-24 ka reports? Now, in clause number 8A and clause number 32, wherever there was a reference of 115BAA, BAB, BAC, BAD, now reference of BAE is also added. Then, in clause number 12 of 3CD, when they are asking that whether the assessee has declared any income under 44AD, 44B, 44BB, etc., the reference of 44ADA was missed out. Now it has been rectified and it is added. Clause number 18, what it says that, what 115 BAC says, let's say in the last year I have followed old regime. Understand the things, I have followed old regime last year. So in the old regime, normal depreciation is also allowed, additional depreciation is also allowed. My block of asset was opening 1 lakh, normal depre 15,000, additional depre 20,000. So now my block of asset has become of rupees, let's say 65,000. That is the depreciated value. So what will be the opening WDV of 1st April 23? 65,000. Correct. But in this current year, now I am started following 115 BAC, that is the default tax regime. So what? But now let's say in the last year, my PGBP income was not enough to absorb this entire depreciation. And it created unabsorbed depreciation. Unabsorbed depreciation worth rupees 5,000 was still there, which is carry forwarded. So now tell me, can I say that this unabsorbed depre actually belongs to additional depreciation? Because at the end it was claimed. So how much PGBP income could not absorb additional depreciation? 5,000. So this unabsorbed depre belongs to this additional depreciation 5,000. Now this 5,000 is carried forward in the current year, but in the current year section 115 BAC is followed. So what if section 115 BAC is followed? You can't claim unabsorbed depreciation. You can't claim additional depreciation. So you also can't set off that much unabsorbed depreciation, which is because of additional depreciation. So even this 5,000 ka unabsorbed depre also I cannot deduct during this financial year 24-25. That is during the year 23-24. But there is one more thing which you are supposed to do. you are supposed to add back this into your opening WDV. Can I say this much has actually not been deducted from the profit, this 5,000, and it will not be deducted during the year also? That means this 5,000 was erroneously taken extra last year. Your opening WDV can't be 65,000, it has to be 70,000. This is the effect which you have to give in current year ka opening WDV. And that the auditor needs to certify in clause number 18, that adjustment of the block of asset for increase in the value of unabsorbed additional debris claimed last year but not allowed this year due to 115 BAC. So because of that much 5,000, your opening WDV will also increase. And that much unabsorbed debris you can't set off in current year also, because it is because of additional depreciation. If this unabsorbed debris is of normal depreciation, then it's okay. You are not supposed to do anything. Your opening WDV will be as it is. You can deduct that unabsorbed debris also. This is to be done only when it is because of additional depreciation. In clause number 19, reference was 35 ABA was missing, which they have added. In clause number 21, disallowance, they have added the disclosure about disallowance of explanation 3 of section 37 subsection 1, which was added during the year. In clause number 22, which is related to interest paid under MSME, along with that disclosure, now very important, disclosure about disallowance of 43B clause H, payment to micro and small enterprise beyond the due date. Even that disclosure is also added. So there are now two disclosure of MSME which auditor needs to give in form number 3CD. One regarding interest of MSME, second is regarding disallowance under 43B clause H. Last, non-resident taxation. There is an exemption for section 10 clause 4G. Let's say you are a non-resident. You are receiving any amount in a banking account maintained in offshore banking unit in IFSC, and it belongs to portfolio of security or financial products of the fund. Now what will happen? If you receive something in India, that is received in India, and received in India is taxable in India, but government wants to promote IFSC, government wants to promote banking accounts in IFSC by non-resident. So what they issued a exemption 10 clause 4G. If a non-resident receives any amount in IFSC ka banking unit, it will be exempt if this amount belongs to portfolio of security or financial product of the fund, or as may be notified. Now some more activities are notified, of which amount received in India under IFSC bank will still be exempt. What are those activities? Investment in financial product by non-resident in accordance with contract between non-resident and capital market intermediary being unit of IFSC. So if there is any contract of non-resident and capital market intermediary of IFSC, and because of this activity some portion of amount is received into the bank account of IFSC by non-resident, it will be totally exempt. That has been clarified by CBDT. Not that relevant, but still okay. This is A to Z statutory updates which are issued by ICAI. So I have just reformed it in a summarized form. It is just the same PDF which ICAI has issued in a summarized version. The wordings are also very much similar to that only. Now, some judicial pronouncement. Now what is judicial pronouncement? Certain latest case laws which came into existence after your syllabus was done. So certain case laws which are added into your list. I have said to prepare a case law list to all the students. Into that list now few more case laws will be added. The very first case law, Supreme Court Mahle Anand Filter System Private Limited versus ACIT. Now what is that regarding to? Let's understand. I have entered into a lease with a lessor. I have given a security deposit of rupees 1 lakh. The total lease term is now coming to an end, and there is some dispute about arrears of the rent or some damage happened in the property. Lessor is asking some compensation from me, and what I am saying is, let's settle this dispute. You forfeit my security deposit, you use that money against the arrears or against that damage expense, it's okay. I waived off my right to claim security deposit. Can I say it is one kind of expense that I have done to settle the dispute? But this is not a revenue expense in the nature. It is related to balance sheet item. A security deposit was under balance sheet. I waived my right to take back that asset. That is one kind of capital expense. And hence Supreme Court said that this kind of expense cannot be allowed under PGBP. It is a capital expense. It will be disallowed. If to settle a dispute, lessee agree not to claim security deposit from lessor, it's capital expense in the nature, not revenue in the nature, hence not allowed as a deduction. Then Supreme Court, CIT versus KBD Sugar and Distilleries Limited. Now understand the issue. Let's say there is a company A Limited. It has 3 units, Unit A, Unit B, Unit C. A Limited is now planning to demerge Unit B and C and make another company B Limited, that is a resulting company. So now resulting company will get all the asset and liability of Unit B and Unit C under the scheme of demerger. So can I say the loss which belong to Unit B and C will also now become the loss of resulting company, that is B Limited, and that B Limited will be allowed to set off and carry forward that losses because it happened under the scheme of demerger. But what assessing officer says, now here there was a small scenario that Unit C was non-functional. It is not functioning at all. It was a closed unit. It had some asset, it had some liability, but a closed unit. No business is going on. So that unit ka loss was also there, which is passed on to B Limited. What assessing officer says, when you read the demerger ka definition, it is clearly written the demerger should be on a going concern basis. But the Unit C is not a going concern, it is dysfunctional unit. It is a closed unit. So the loss which arised of the dysfunctional unit, it is a closed unit, not a going concern, condition not satisfied, will not allow to carry forward that much loss which belongs to Unit C because it is a closed unit. See, what is the question in this case law? Section 2 clause 19AA lays down the condition of demerger, that it's a transfer by demerged company to any resulting company in such a manner that transfer of undertaking is on going concern basis. So what AO stated that the words written going concern means the loss of dysfunctional unit of demerged entity cannot be carried forwarded because it is not going concern on the date of demerger. Supreme Court rejected this. Supreme Court held that here the wording going concern does not mean that the units which are transferred should be on a going concern. The going concern word means that this demerger process should be done in a way that was done with a going concern entity. It don't have any reference with the units which are transferred, that whether it is a closed or going concern. Even the closed unit can be transferred. The losses can be set off and carry forwarded by the resulting company. Supreme Court held that Act does not state the undertaking being demerged ought to be going concern at the time of demerger. It only states that undertaking being demerged should stand transferred in a manner similar to the manner in which going concern entity is transferred. Therefore, the assessee is entitled to set off and brought forward the losses under section 72A. Then Supreme Court in the case of Secunderabad Club versus CIT. This kind of case law we have already done in the class also. Very similar case law. Now what it says that, let's say there is a cooperative society to which principle of mutual concern is applicable. What is principle of mutual concern? Any income earned from the members are not taxable because cooperative society and member is one and the same. That is called principle of mutual concern. So there is any kind of fees annually which are taken from the member by society, not taxable, something like this. So let's say this society is there, Secunderabad Club is there. There are so many members are there. Members have paid annual fees to this club. Principle of mutual concern applicable. That much is not taxable. That club is now having surplus. It want to invest somewhere. Now one of the member is into banking business. So what all said, rather to invest somewhere else, why not to give this surplus to our member only who is doing banking business? So the club transferred this surplus to that member in the capacity of banking unit. And now that member is giving interest to this club because that club has put surplus fund with them. So interest income is being received by the club. Now it is received actually from the member. So what club is saying, even this interest on fixed deposit is also principle of mutual concern. It is also not taxable. Whereas Supreme Court has said that though that person is a member, but he has not given you this income in the capacity of a member. He has given you this income in a capacity of a banker. And that's why you have to see the nature of income, that why it is given. It is given in the capacity of member, principle of mutual concept applicable. If it is not given under the capacity of member but in some different way of like a business person, that income will be taxable. Does the principle of mutuality apply to interest income derived from fixed deposit made with the bank by the club if such bank are member of the club? The Supreme Court held that interest income earned on fixed deposit made with the bank by appellate club has to be treated like any other income from other sources within the meaning of 224, that is income ki definition. It would be liable to be taxed under the provision of Income Tax Act. This is because interest is not earned from bank in a capacity of member. Then a very important case law which is relevant in so many aspects. Supreme Court CIT International Taxation versus Air India Limited. There are 2 points which we need to consider to understand this case law. First, we just discussed section 206AA. If the deductee is not furnishing permanent account number, then TDS will be deducted at applicable rate or 20%, whichever is higher. Now there is one more section, section 90, which says that if any transaction is covered by DTAA, then and TDS is to be deducted, then you will deduct TDS at DTAA ka rate. Now let's say DTAA ka rate of TDS is 5%, whereas in income tax for the same kind of transaction the rate is 7%. At what rate you will deduct TDS? 5%, because section 90 says that to any assessee to whom DTAA applies, which provisions will be applied? Which is given under the Act or which is given under DTAA, whichever is more beneficial. Now what will happen if there is, let's say, Air India Limited paying something to a non-resident, and to this transaction DTAA is applicable. DTAA says that 5% TDS is to be deducted. Okay. But as per income tax, it says that if the deductee do not furnish permanent account number, deduct the TDS at applicable rate or 20%, whichever is higher, section 206AA. That non-resident is not having permanent account number. So as per section 206AA, how much TDS will be deducted? Directly 20%. So what Air India says that, to me what is applicable? Act or DTAA, whichever is more beneficial. What is more beneficial? 5%. So Air India deducted only 5% TDS and not higher TDS. Law says that 206AA, AO says that 206AA is overriding DTAA, which is actually not. Supreme Court has clarified, if the tax has been deducted on the strength of beneficial provision of DTAA, the provision of 206AA cannot be invoked for higher TDS. It don't override section 90. Section 90 is rather overriding DTAA or income tax, whichever is more beneficial. So you don't need to deduct higher TDS of a non-resident if DTAA is applicable. You can deduct TDS at a rate whichever is more beneficial. Okay, one issue which I guess many taxpayers are facing, many consultants are facing. Delhi High Court has clarified BDR Finvest Private Limited versus DCIT in the favor of assessee. Let's say I earned rupees 10 lakh of professional fee, and on that 10 lakh rupees of professional fee, my TDS is deducted under section 194J at the rate of 1 lakh. So I am under the impression that my TDS is deducted in the name of government. That much money will be paid by the deductor to the government. I filed my return of income. I disclosed 10 lakh rupees of income gross basis, and that 1 lakh rupee of TDS which is deducted, I deducted it from my tax payable and I filed my return. But unfortunately that deductor has not deposited the TDS to government, and so that much TDS is not reflected in my form number 26AS. I hope you understand, form 26AS is a form wherein my all TDS are reflected, which are deposited by deductor, of which credit is given to me. In my form number 26AS, this 1 lakh rupees of TDS is not reflected because deductor has not paid the same to government. So 143(1) ka order came. When I filed my return, 143(1) has to be there. Comparison between return of income and as per income tax utility. In that, what 143(1) has done? 1 lakh rupees of credit is not given because it is not reflected in your 26AS. So basically 143 subsection 1 has raised a demand of rupees 1 lakh plus interest, etc. Now what is deductee ka stand? That as per section 205, there is a bar on direct demand from deductee if tax is deducted. If TDS is deducted, section 205 says that government cannot ask the amount again from the deductee. It has to do the recovery from deductor. Then the question arises, what will prevail over here? Whether the government can ask the amount from deductee because in 26 AS 1 lakh rupees of TDS is not reflected, or that 1 lakh rupees cannot be asked again from the deductee, it has to be asked from the deductor. It has to be recovered from deductor, not from deductee. What deductee need to do? Sufficient proof and evidence is to be given that my TDS is deducted. Contra confirmation you have to submit. That's it. You will get the credit. Now that recovery of rupees 1 lakh will be done from whom? Deductor. Is the deductee entitled to claim credit of tax deducted at source if the amount of TDS is not reflected in Form 26 AS? Because deductor has not deposited it with government. So as per section 199 subsection 1, if any amount of tax deducted at source paid to the central government, it will be treated as an payment of tax on behalf of the person. Now dekho, why this case arised? Section 199 says if tax is deducted and paid to central government, then it will be treated as payment of tax. So what AO says that deductor has not paid the tax to department. So 199 can't come into the picture. We can't treat the TDS as payment of tax. Will not give the credit because the money has not been paid to central government. But what assessee says, then what about section 205, which says that if tax is deducted, assessee shall not be called upon to pay the tax himself to the extent of tax deducted. That section do not say anything about payment to government. Na? So AO has taken a stand of section 199, assessee has taken a stand of section 205. Delhi High Court has favored section 205 overriding. It said that if 199 is saying that what will be treated as payment of tax when it will be paid to government. Okay. It is not written na, that it will be paid to by deductor, then only it will be treated as a payment of tax by deductee. Section 205 has a clear wording. It don't have anything which reference to payment of TDS to government unless and until amended in any future budget. So accordingly, High Court held that section 199 cannot come into the way by deductee. In case deductor failed to deposit to TDS, you can't again ask the amount from deductee. Therefore, the deductee should be given credit of TDS, though it was not reflected in form number 26 AS. No recovery toward TDS could be made from assessee in terms of provision of section 205. Because 205 has a valid shield for the deductee. Overriding section. Okay. Supreme Court in the case of Bharti Cellular Limited versus ACIT. Fine. Now, there was a judgment which came in statutory update last year, which override the judgment of Bombay High Court, Japan Airways Limited, Supreme Court judgment, which is done in the classroom. That let's say there is an airline, there are some agent. So airlines, agents and passengers. Airline is basically giving the tickets to the agent at for 11,000 and agents are allowed to sell the tickets at any price they want to, subject to a minimum cap of 11,000, maximum cap of 15,000. So now let's say airline gave the ticket of 11,000 to agent, agent sold the tickets to passenger for rupees 12,000. Now when the tickets are sold, airlines give a fixed commission to agent of rupees 500 also. So earlier Bombay High Court said that what is commission in this case? This 500. Whereas what assessing officer said that agent also got more 1,000. Na? It purchased the tickets from airline 11,000. It sold to passenger 12,000. Indirectly, there is one secret commission also 1,000. Additional commission is also there 1,000. On that also, this airline is supposed to deduct TDS. So that airline said that we are supposed to deduct TDS only on 500. Whereas AO said that you are supposed to deduct TDS on the 500, correct, plus of that rupees 1,000. That is the difference between purchase price and sale price. Because that is also one kind of additional commission that you are giving to the agent. What was the view of airline? That how we come to know that at what price that particular agents have sold the tickets? AO said it's your choice. You ask that list from agent every month, you deduct TDS. Bombay High Court said no, this is not possible. Deduct TDS only on 500. Supreme Court says no, this is possible deduct TDS on 1500, that is on fixed commission also plus on additional commission also. Why? Here the agent are just behaving, selling the ticket for airlines. It is not selling goods, it is selling services. You understand? It is not like coupons etc. They are selling the tickets. The passenger will fly in the airlines. Airlines will give all the services to the passenger. Agents are just behaving like an employee of the airlines and selling the tickets. So at what price the tickets are sold is high, at what price tickets are sold is low. The difference is one kind of commission of the agent. TDS under 194H is to be deducted. On the same line, assessing officer now went with the telecom companies. Let's say Vodafone sold a startup kits of rupees 10,000 to distributor. Let's say some recharge coupon, something like this. And they distributed sold it to the customer for 12,000. So whether Vodafone is required to deduct TDS on this rupees 2,000 of balance amount, which is one kind of additional commission. Same case like Japan Airlines. Here Supreme Court said no. Here no TDS is to be deducted on this difference. Are cellular mobile telephone operator provider required to deduct TDS under 194H on the difference between discounted price at which it sold the startup kit, recharge coupons etc. to franchisee or distributors, and if the sale price is higher? So the answer came that no, it is not supposed to deduct TDS. Why? As per explanation to section 194H, commission or brokerage, it include any payment received or receivable directly or indirectly by person acting on behalf of another person for services rendered or for any services in the course of buying or selling goods or in relation to any transaction relating to asset, valuable article not being securities. In airline wala case, what was happening? The service is finally being provided by airlines. It is not like goods. And finally the passengers are the person who is receiving the service. Agents are just a mediator. Here the distributor are actually purchasing the recharge coupon like a goods, like a normal buyer, selling the same to customer. It is like any normal buyer and seller. And that's why the assessee is not the envy to the transaction between distributor and third parties. Once the recharge coupon or startup kits are sold to the distributor, the company is out of this. Either it is sold or not sold. The company don't do anything now. Company is having no obligation now. Company is not a party between them. It's like goods sold to distributor. Distributor will sold at any price to the customer if they want. If therefore impossible for the assessee to deduct TDS and comply 194H on the difference between total consideration received from the third party and paid to the distributor, on that TDS cannot be deducted. But let's say there is one Kerala High Court judgment also. Now let me just reconcile that. Kerala High Court judgment, what it says that it is of Vodafone, that let's say Vodafone has a recharge coupon of 100. It will be sold to the customer for 100. But just to maintain the relation with agents, what Vodafone is doing, it is selling the recharge coupon for rupees 90 to agent, which agent will sell at a fixed price of 100 to the customer. Here the price is fixed at which it will be sold to customer. Vodafone is giving discount to the agent so that agent can also earn something. Now this is 10 rupees which is given discount is clearly commission given. On that TDS is applicable. Understand what is the difference between first case and second case. Supreme Court judgment says that you sell something at 100. You sell something at 100 to distributor. Distributor can sell at much above price, let's say 120. Now that a company can't understand na, that at what price distributor is selling to the seller, to the buyer, and hence TDS not applicable. But in the second Kerala High Court judgment, what I said, which we studied in the classroom, company is selling 100 rupees of recharge coupon just for 90 rupees to the distributor, and company knows the fact that distributor will sell that for sure for 100 rupees. So in that case, the 10 rupee discount which is offered by company to distributor, that is a deemed commission. On that TDS is applicable. Now, if this 90 rupees ki coupon is sold for let's say 110, then can I say that distributor earned more 10 rupees? On that TDS is not applicable. That is said by Supreme Court. Are you understanding my point, people? Then Supreme Court CIT versus Industrial Development Bank of India Limited. Now you all know that there is a section called 263, revision in the favor of revenue. If any commissioner of income tax, principal commissioner of income tax thinks that any order of assessment, reassessment is passed in a manner prejudicial to the interest of revenue, it can revise the order up to 2 years from end of year in which such order was passed. But now what if against that order there is some appeal going on? Let's say there is a assessment order. Assessment order contains 3 things, A, B, C. There are 3 transactions which are decided in that assessment order. Transaction B and C is now into appeal, whereas transaction A is finally settled, against that no appeal is done. Can this order be revised? Yes, this order can be revised only for matter A. Matter B and C cannot be revised because it is pending into appeal or it is decided into appeal. Then income tax department don't have a right to revise those matters. Appellate authorities have considered that. But matter A, which is just finalized by assessing officer, it has not went into any kind of appeal by assessee. Commissioner has a right to revise that matter. It is called concept of partial merger. Not like section 264 that has total merger, this has partial merger. So those matters which went into appeal cannot be revised. Those matter which has not went into appeal can be revised. Question arises that 2 years ka time limit of revision is applied from which year? From the year in which that original order was passed and or the year in which that appeal order was passed. Can I say this matter A has nothing to do with appeal order? Then why we calculate 2 years from appeal order? We have to calculate this 2 year from end of the year in which that original order was passed. So the limitation period of exercising the powers under section 263 reckoned from the date of passing the original assessment order rather than reassessment order for issues covered under original assessment but not covered under reassessment. So what example I gave of appeal, the same example is applicable for even reassessment. So if let's say there are 2 matters which are gone for reassessment, then those 2 matters, if it is to be revised, the period will reckon from that reassessment order. But that matter which is not considered in reassessment, of that 2 years will reckon from that original assessment. That has been done via another judgments also. So this concept is already done in the lecture. It is nothing new. Concept of partial merger, which we call it. Then Delhi High Court GoDaddy.com LLC versus ACIT. What GoDaddy.com do? Sometimes, let's say it is a foreign company. Those who want to register trademark, patent, it just make the registration process. It take the fee for registration and it get that patent etc. registered for the ministry, to that registrar. So what AO said, that whenever you are paying something to GoDaddy.com, it is one kind of royalty because it allowing you the right of trademark, patent etc. And that's why you need to deduct TDS as per royalty. It is a royalty. Whereas what assessee need to say that this is not a royalty. I am just doing a process of registering the things. Who am I to give the rights to somebody when I don't have that asset in my name? I am just doing that asset registered on the other portals and taking the fees. That is not royalty. That is correct also. Whether the fees received by foreign company as a consideration toward providing domain name registration service amounts to royalty. As per explanation 2, royalty means consideration including lump sum consideration but excluding capital gain, inter alia for transfer of all or any of the rights for granting a license or so, for patent, invention, model, design, secret, formula, process, etc. But understand, if that asset is in my name, I'm allowing that right to somebody else and I'm taking consideration, that is royalty. What if those asset is not under my name? I'm just providing a service to get it registered. It is not royalty. Yeah, I'm giving them right, but that right is passed on from the concerned registrar. I'm just giving them the service to get it registered. It is not royalty. Here assessee is not the owner of the domain name. Hence it does not confer the right to use or transfer the use of domain name to its customer. It is just not the owner of domain name but merely facilitating the registration of the name which registrar and charging the fees. In this case, the appellate or assessee is not only acting as a registrar and thus offering its services to customer for having their domain names registered. Accordingly, High Court held that fee received by assessee for registration of domain names to its customer cannot be treated as royalty. Last, Madras High Court Duraiswamy Kumaraswamy versus PCIT. Now you understand, if you want to claim any kind of credit under section 90 or 91, either having DTAA or not having DTAA, whatever is foreign trade, foreign tax credit is to be claimed or double tax relief is to be claimed. For that you need to file form number 67. Form number 67 was to be filed up to the due date of 139 subsection 1, which is amended. Now form number 67 to claim that relief under 90 or 91 can be claimed up to the end of assessment year. It can be filed up to end of assessment year for any kind of return, either original return of 139.1 or belated return or 139.4. So now to claim that relief of DTAA, form number 67 can be filed up to the end of assessment year, either for original return or for belated return. Now what happened? Assessee filed the return claiming double tax relief, forgot to file form number 67, but filed it before assessment proceeding is coming to an end. It filed it, but when 143(1) ka order came, it disallowed the credit by saying that you have not filed form number 67 before filing the return and hence will not allow you the credit. It disallowed the same. So now what here Madras High Court has to say is that 67 is just a document. It is just a admin kind of thing that is being done, and because of that you can't disallow the credit. If that assessee has not filed that form number 67 at all, it is okay, you disallow the credit. Array, but that assessee has filed form number 67 before 143(1) ka order, you can't disallow the same. Your requirement has been fulfilled, you have to give the credit. So see what is written. Can the claim of foreign tax credit be accepted if the taxpayer inadvertently fails to file form number 67 along with return, though the form is filed before receipt of intimation of 143(1)? The High Court held that return was filed without form 67. The same was filed before intimation of 143(1). Filing of form 67 for foreign tax credit in rule number 128 is only directory in the nature, like admin transaction. The rule is only for implementation of the provision of the act. It will always be directory in the nature. Therefore, in the present case, the claim of foreign tax credit cannot be denied. That has been said by Madras High Court. This all were statutory updates and judicial pronouncement which are issued by ICI for November 2024 attempt. I again repeat, there is no amendment from the current budget that is applicable to you people. For you, there is no further amendments apart from this 2 PDF. Both these PDF are available in the YouTube description link that has been shared in this video. And for any kind of further query, you can contact me, you can contact any other professor of DT of Judicial classes. We all are ready to help you out. We are a team and will be always be in the benefits of the students. We will be helpful for all of you. Kindly take maximum out of it. Thank you so much and all the best for your exam.